Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, January 6th, 5:51 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what's key for next week, and update the world famous 21 over 21 leaders list. Let's get right into it. State of the market has changed from correction to correction with a short-term uptrend. Technically, all rallies are bear market rallies until we get above the 200-day moving average and or the 4,000 level on the S&P. You can see over here on the trend gauge, market leaders neutral, but the arrow flipped to green after a nice participation in leaders today. Really a broad rally and not a lot to pick apart with what we saw in the action today. Short term, still in a bearish downtrend, one close above the 21 across the board moves the sub arrow to neutral. Let's see what Monday brings. Medium term arrow flipped to green also into the 50-day moving average on the S&P 500, and that's as far as we went. But very strong day today, and the issue is there's very strong leftover resistance right at that 3,900 area, something we need to watch closely. Long term, still in a downtrend, Dow above the 200-day moving average as it has been. Let's see if we can get some of the other indexes to participate into that. That's really what we need to look for. So what happened today? We've been talking about 14 days in a tight trend between 3,800 and 3,850, give or take a few points to the upside and downside. We knew the market was coiling. We knew we were ready for a big move. And before the market opened, the non-farms payroll report came out, and really it was a disappointment on the headline number. We added more jobs than were expected, and that's not what Jerome Powell's looking for. He's looking for the labor market to moderate so that we can continue to calm inflation down and let interest rates keep the economy from overheating, but at the same time somehow engineer a soft landing so that the recession doesn't hit too many people. However, inside that non-farm payroll report was the average hourly earnings where it came in less than expected. So any decrease in wage inflation is seen as a big deal. Then after the open, we had an ISM report come out, and that showed mild contraction versus expansion that was expected in manufacturing. The market had another leg up to the upside after that, and we had a very strong close. So basically, we gapped up 0.8%, gave it all back after the open, made it look like this was a complete attempt to trap bulls. Came all the way down, held 3809, didn't get to 3800, and then a big rally kicked off from 945, and then additional strength after 10 o'clock. Strength and volume and breadth, and growth stocks participated. It wasn't a junk rally. In fact, ARK-K underperformed, but it was not slanted one way or the other. All 11 of the spider sectors were higher. Really, it's what you're looking for to build on if you're going to get any sort of strength into the rally to kick off the new year. So bottom line today, G6 up 1.9%, S&P up 2.3, NASDAQ 100 up 2.8, Dow up 2.1, mid caps up 2.5, Russell up 2.2, global diversified 60/40 up 1.7, GROTECTION up 0.03. So basically we came into today essentially flat. We were long the Dow, short the S&P, and we had Boeing and Nugget, and didn't make any trades with the initial gap up, and then with the fade down to 3809, still sitting tight. Then we started to break above some key levels, 3850, and we bought a stock that had a gap up this morning, AEHR, and then we continued with some more strength. We added to our Dow long, and we added to SDY, which is a dividend ETF. Dividend stocks were strong in the morning up until noon. Then early afternoon, they started to just kind of stay in line with the S&P, and more growthy names took over and started acting well. So that was the strength and the breadth that I was looking for in the market, and we continued to add. So we completely offset our S&P short because we got above that 21-day moving average, and when we look at the chart, I'll show you, we got above it, back below it, back above it, back below it, and then tried to test it several times, and it held and then made a higher high. And at that point, that was when we completely got added. We bought UPRO, and that completely offset our short, so getting us flat on that, and added another stock, a leader, ELF, to the portfolio. We'll go through all of the charts, and we'll go through all of the action that we did today when we fire into the tail of the tape and review the 21 over 21 list. So let's fly into it. Let's start off with what we do here at Revere, protecting the downside. We did plenty of that in 2022. How about a rally to kick off 2023? That would be a welcome change. Here's the S&P 500. Let's go to the 60-minute chart and see what we can see here. So here's the gap up. Well, let's start out the 5-minute chart. It's easier to see the gap up and then the very harsh 10-minute, 15-minute selling down, making you think that the gap up and right into this 3850 area, which has been resistance. Big failure all the way down to 3810, thinking no big deal, just going to stay inside this range. But the market seeks to fool the masses. And here's the big rally that started to take place. Put in a deep cup and a handle here, but then at 10 o'clock when that ISM information came out, we took off to the upside past 3850 and rallied very quickly up to 3880. Then we formed a base over the next couple of hours, little cup. You can see the cup with a little handle here, and then broke out above there about 2 o'clock, rallied strongly up into 3906. Now, this was the key area here. And we'll take a look at it when we look at the charts on the daily. This is when we started back testing that 3870 area, which was the 21-day moving average. We got up, we tested it, we held it, and then the follow through strength is what led us to start putting even more cash to work. And then really a controlled pullback into the close down to 3800. But where did we stop? We stopped right at the 50-day moving average that was overhead. Let's go to the 60-minute chart here. We're not out of the woods by any stretch. And in fact, the fail at 3900 really sets up a good shorting opportunity if we can't get any follow through strength. That's why we didn't sell our short, but we went long to offset it. So it can be one of them will win. We'll either go back above 3900 and we'll cover the short, or we can break back down and we'll start to unwind the long that we put in, because this is technically the area for a low risk short. If you look at the daily chart, right at this 3900 area, 3904, which is where the 50-day moving average is, and that 50-day moving average coincides with that 3900 area that has been resistance slash support. Really going back, you can look to the left side of the chart here, and it's been a key level all through May, June, July. It was in September. It was in November. It was when we were trying to rally here that, and then it broke after the Fed, the FOMC, that last meeting. Here was the breakdown here on 12/15 below that level. Then we put in this tight base for about 3 weeks, and now we're attempting to break out of that today. You can see here, let me blow this up a little bit. You can see here the failure into the 21-day, the high here, 3878. 3873. Today, the 21-day moving average was at 3871. So from 3871 to 3879, you take a look at the 5-minute chart here. This was the area that we rallied up to. Okay, got above 3881, then we started pulling back here. around that area and battling, and then we got back above it, and then we back tested it again, and it held. And then when we made this higher high there, this was the area that I'm talking about that corresponded with that breakout from the intraday cup and handle. So figure 39.70 to 39.80 right there, that area earlier in the week. You can see it over here, 39.73, 39.68. Let's go to a 10-minute chart so you can see a little more those 2 days where we got into that area. This is the failure into the 21. This is the other failure into the 21. So it's a natural area to pause around here. We got up into 38.70, came down up to 38.80, came down, got back above it, and they then made a higher high. So this is a very clear attempt to break out of that range above that 38.80-ish level. Got up to 39.06 before pulling back, and then I said again. So we cleared one level, the 21, but we're into the next level up, 3,900, which is the 50-day moving average. So not out of the woods yet. Uh, Above, we made a higher high versus 1221, which was the prior high. And in fact, we closed above it at 38.95. So some good stuff going for the bulls today. Breaking above the 8, breaking above the 21, rallying strong. Volume on the NASDAQ was higher than the prior day, slightly less. The tentative numbers that I'm looking at on the MarketSmith website, not NYSE volume was slightly less than the day before, but NASDAQ was stronger. And so technically that meets the criteria for a follow through. We'll see if we can get true follow through strength. And this was 1228 was when we made a new closing low. IBD went to market in correction. So by the book, this was a day 6 follow through day off of that low. Again, the volume is going to be dependent. The price action was very clearly there, above 2.2% on all the indexes, 2.1 on the Dow. But again, it's one day. We engaged in some positions. Our stops are in place. We fail at the 21. It'll be very clear that this was just another bear market rally, and we'll see where we go from here. But um, when I started on Tuesday or on Wednesday, showing that we're actually having breakouts and some of them were holding, we got a bunch more of them today. So that's a check mark in the column of the bulls that we hadn't seen, even when we were rallying at higher levels back here. The setups just weren't there for breakouts, but now we're starting to see some, and it could be a tradable rally. I mean, we get above 3,900, get into 4,000, pause a little bit, and then take off to the upside. But again, it is a bear market. We are facing a recession. We don't know how much the market has priced into the recession, but we did see broad strength today. So there's always pluses. Nothing is ever clear in the market. There are always shades of gray. You're just trying to weigh the evidence on what's bullish, what's bearish, how are the setups, are stocks behaving, or are they making a nice move one day and giving it all back the next day? And you start small, put your positions on, put your stops in place. And if they start working, you add to them. And before you know it, Bob's your uncle. We're above the 200-day moving average and in a full-fledged bull market. But the market climbs a wall of worry. Right now, it's worried, seems less about inflation and more about recession. So, how we react to negative news is going to be important. We had 4 pieces of negative news prior to today that were related to the employment picture, and the market shook them all off. There was intraday volatility, but it couldn't break below 3,800. A market that just can't go down eventually has to go up. Um, and that's what we saw today is some coiled springs. We talked about how tight yesterday was, even with some bad news. It was a bad day, closed at the lows. But that was the reaction was positive to the news event today, and we'll see next week if it's something to build on. Go to the NASDAQ 100. It rallied up into its declining 21-day moving average. A move above 270 here is really what the bulls want to see. That gets us above the 21 and above the higher high and into the higher part of this 3-week range. We know the NASDAQ had been lagging relative to the other indexes, but we do want to see some strength in there. There are, plenty of stocks that are in the Nasdaq 100 that aren't tech related. Software continued to have an underperforming day today. Um, all the software stocks for the most part underperformed. Microsoft only up 1% versus 2.8% up on the Nasdaq 100. IGV, the software index, only up 1.5%. Software is a big part of the Nasdaq 100. We need to see some participation from some stocks in order to see follow through to the upside. Let's go to the Dow, which was the leader out of the gate today, and then later in the day, the more growthy part of the index is caught up. So you can see here above the range of the last 3 weeks, above the 21, above the 50. 21 had been acting as resistance 1, 2, 3, 4, 5, 6 times over the last 3 weeks. Let's go to a longer term chart. Here's a 30-minute. You can see that high was this 33.4 area, 33.4, 33.4, broke above it today. So another breakout above the range, another feather in the cap of the bulls. Let's see if any pullback now. We want to hold 33.4 on that pullback, really 33.8 to 38.380 to 33.4 should hold on any pullback. If we come into it, you want to see it bounce off of that to continue to show strength in the Dow. Let's go to SDY. This was the ETF that we bought today. This is is a strong. Basically, it's a dividend play. Lot of stocks with nice dividend yields. Some of them not performing as well, but your yield works. And if it's showing relative strength, which it has been, you can see here lately, uh, strong move above the prior highs of the week, above the 50 day, above the 21 day. And as I said, it had its pullback. It based down on the cusp of oversold, not quite really spending as much time in oversold as some of the other indexes, and it was one of the first to come out. So that was one of the reasons why we picked that to add some of our exposure. So we've got 10% in the Dow, 5% in SDY, and the equivalent of 10% in the S&P 500 with our UPRO long. Let's go to mid caps now, MDY. I I've been talking about how this 448 to 450 area was a mountain of resistance with all the moving averages there. But let's go to the 30-minute chart, and it's very clear what we were able to do today. Get above that 448, 450 level, pull back, tested it, held, and made a move up to 455. So I'd like to give the award of the day to the mid cap index for uh, outperformance relative to the other indexes and relative to a recent performance. I've been talking about, I mentioned yesterday how subtle relative strength was showing up in mid caps 2 weeks ago, a little bit of a flag, and early this week, and up 2.55% today, looking good there, mid caps. Let's go to small caps. It's Russell 2000, so we know there's still a lot of junk in there. Did get above the 21, did break above the recent highs of the week. 50-day moving average still overhead. Let's go to the quality small cap index, if you want to call it that, and I will call it that. It's SLY. The S&P 600 small cap index, a little bit healthier, subtle relative strength versus the index that's broader 2000 but has less attractive stocks in above the 21 coming into the 50 and the 200. That's what we want to see happen there with the small cap index. How about the equal weight indexes today? RSP up 2.4%, slightly better than the broad index, above the 200-day moving average, above the 50-day, above the 21. Breakout for RSP of the range over the last 3 weeks. Good stuff there also. How about equal weighted NASDAQ 100? Not bad. Into the 50-day, better than the QQQ, but still lacking some strength relative to what the other indexes are doing. How about the VIX? The market's up, you'd expect the VIX to be down, and it was down 5.8%, back below this 21-day moving average, which is flat now. Could not get above the declining 50-day moving average, coming into this support area down around 20. If the VIX gets down into 20 and starts breaking and goes to 19, 18, you're going to be seeing a strong rally in the S&P 500. But this is a concern. That's a brick wall, well, I should say a brick floor of strength in support on the VIX there. How about the dollar? Dollar took it on the chin today. Outside reversal. It initially showed some strength. Let's look at a 5-minute chart. Initially showed some strength. In fact, acting complete opposite of what the market was doing today. So it gapped down when the market gapped up. It made a high relative to yesterday while the market was pulling back, and then look at this waterfall effect in the dollar over this 20 minutes, and this is when the S&P 500 really started its rally, and then weakness all day, all the way down into the close. So the dollar participated, which means this was a one-day uh, move above the 21, back below it, back below the 8, which has been controlling the downtrend, the 8 and the 21, this whole time over the prior 2 months. And so yesterday's looking at like failed strength in the dollar, and the bulls are very happy to see that. The not the dollar bulls, the market bulls. How about bonds? Let's take a look at junk bonds first. Another strong day today. Look at that, clearly breaking out of their range over the last 3 weeks. Uh, more showing more strength than the indexes. In fact, how about the broad bond index? All bond prices were up today, which means the yield was down. So coming down, bouncing nice off the 50-day, back above the 21-day. Prices are up. That means the yields are coming down. That benefits stocks. Let's go to the 10-year 0 TNX. The yield down, big move down. So this is looking like a failed break above the 50-day, back below the 21. The 21 handled this entire move down while the markets were rallying, and now it looks like we're falling into that camp again. Big move down, 4% on 4%. Well, it's relative, but it's a 4%, really 40 basis point move on the TNX. And let's go to the 30-year TYX. That's a big move. 2.79% down. So another failure at the 50-day, back below the 21. Falling rates are good for stocks, but again, falling rates aren't going to slow the economy. So it's a double-edged sword. Everything is a double-edged sword when you're dealing with what the Fed's trying to deal with, as far as trying to uh, manufacture a soft landing here for the recession after pumping all the money that was pumped into the economy. So if the dollar was weak, you'd expect gold and silver to be strong, and they were. Gold, a new recent high, bouncing off this ADMA, up 1.9% today. Very nice. Silver had a failed breakout. 3 days trying to rejoin the party, still in its range, not a breakout here, but this is a failed breakdown below the 21 now, just one day below it, and gold stocks continuing to lead the parade, making a higher high. Man, that yesterday, that pullback to 30 was a perfect spot to get back in if you missed the initial breakout. And breakouts, 50% of the time, will retest the pivot. That's what you saw yesterday on lower volume, and then follow through strength today, big time on GDX. We own NUGT, but wish we owned more of it. So that is those are the broad indexes across the board. Let's go to the tail of the tape now. I added short-term uptrend to the state of the market. The stochastics on the indexes are positive. G6 also. NASI RSI. This forecasted the whole thing. This turned up. This is the McClellan summation index on the Nasdaq. This was the first thing that really pointed to the possibility that the markets might rally. Dollar back below the 21. TNX, TYX. They're back below the 21. uh, VIX down at 21, fear and greed up to the neutral area. Bull case trying to kick this off here with the short term rally attempt. We do need to see some follow through to get us off this bear case when we failed with the rally and broke below the 21 back in mid December with the FOMC's hawkishness. Here's the news and the non-farm payroll data that I already referenced. Day count goes from down one to up one. One day above the ADMA, one day above the 21. Excuse me, EMA. Expectations neutral coming into today. That strong rally into 3,900. They're still going to be neutral. We've got the 50-day above there. I'm not giving the market any benefit of the doubt. very clearly we're seeing reasons to give it the benefit of the doubt, but there are as many, not as many. I would say there are probably a third of negativity and two-thirds positivity. But until we get through that 50-day moving average, and then more importantly, the 4,000 level to get above the 200-day moving average, you have to temper your expectations. Although, as I said, leading stocks are acting better as far as breaking out from bases, making new highs, and holding on to those highs. Levels on the S&P above support resistance into this resistance area, into the support resistance level on the NASDAQ 100. This harsh shakeout, the gap up, the gap up fooled the bears. The gap down, sorry, the gap up burned the bears. The move lower. Anybody that bought the open was underwater, and then, like I said, the market certainly fools the masses, and it did its job today doing that. Sectors 11 out of 11 up, bond prices up, silver and gold and silver stocks. Tech and real estate were the best two spider sectors within the S&P. Semiconductor strong, solar strong. Pick, fantastic day, up 4.7%. Biotech and healthcare were the laggards today within the spider sectors, up less than a percent. Um, and then on the downside, the only two things were the dollar and bond yields. Our focus will be on BA and Nugget. That'll get covered when we go to the 21 over 21. So these changes to the portfolio moved our exposure from basically flat to 27% of the S&P 500. And let's take a look at what we did here. So AEHR had a fantastic reaction to their earnings report. Uh, it has a 19% short interest, so it might have overshot here early. We bought it in the 23s, and so we're slightly underwater here, but it's only a 1% position. That 1% will allow us to give us a little bit of room below the low of the gap up day and below the 21, and still limit our loss to 0.1%, which is what we do when we target when we buy just a 1/4% or a quarter size position, which is what this is for AEHR. ELF has been a leading stock, holding up, not making much price progress, but always holding the 21. There's the volume that you want to see today in the breakout, up 4.4% on 141% average volume. Let's take a look at the weekly chart here. You can see how tight this was. Nice cup, ran into the 50-day, another move up, 50-day, and taken out. Second touch of the 50-day after a breakout from a base is still safe to buy. It's the third and the fourth one that you have to be concerned about. So that's a stage one base. This flat base here was the stage two base. So it's coming out of a stage two base, relative strength at a new high. Um, and really, from a fundamental standpoint and the way it's acting, everything you could ask for in a can slim leader. And that's why we bought into it today. I talked about SDY, why we bought that. UPRO, how we added that to offset our short, and we'll see what happens now that we're at the 21 and the 50-day. These are the top of the range, trying to break out of the top of the range. If we do truly break out, then we'll get rid of the short. The UPRO will rack the gains up, and we expect the Dow and the SDY to contribute gains to the portfolio also. So bottom line, gap up on NFP data, follow through strength when the ISM came out above the 21, but into the 50-day, and that 50-day and 3,900 is a big resistance area. You can see here. Here's the flattish. It's flat, but it's still gaining about a point or two a day on the 50-day. But this big 3887 to 3907 area has been major support resistance line. That's where we ran into today. So we've got both of those that we ran into before running out of steam today into the close. But above the 21 day, today gave the bulls what they were looking for. The question is it a false bear market 1 day rally, or is it something that we can build on? So let's get to the 21 over 21 now. And as always, we'll start off with what we punted out of the list. And starting with Sting, this was in here for an extreme period of time. but the warmer weather is casting a pall over everything Europe related and natural gas related. The 21 finally rolled over, and a harsh break below the 21 day on, or I'm sorry, below the 50-day on volume is always a sell signal. Uh, MBLY, Mobileye, we got stopped out of this today. Big bounce back today. Stopped out with the second move below the 21, below the 21 where it had been holding during this entire move up. False move higher on the first day of the year, false move lower the last couple of days in today, but it did go into the declining 21, and that's where it ran out of steam today. It may be time to form a new base after it did have its first run up to plus 20 to 25% after this first breakout of this IPO base. Also booted was TMDX, which we got stopped out of 2 days ago and yesterday. You can see it below the 50-day moving average here. The 21-day has rolled over. The story is still fantastic, but we need our price action to sync up with the story. Every stock on Wall Street has a story, right? And then finally, SMAR. This really didn't get anything going since we added it to it. I think that maybe I was a little bit enamored because I saw it was a software stock, the king of the software stocks, but that crown uh, doesn't carry much weight right now, and all software stocks got beaten down this week. It's just price to sales if you don't have earnings, and this one didn't. But hard break below the 21 and the 200-day moving average. So those are the four that got punted. We'll start off now with what got added, the first four. And I had to put a Chinese stock on because of the strength across the board. The best and most trustworthy to me is JD.com. You can see the big move out on Wednesday on volume. Lighter volume pullback the last 2 days, still holding the 8. This looks good. Look at that nice tight uh, consolidation along the 200 and the 21 there before the breakout. Next up, Las Vegas Sands. This is also somewhat China related with them reopening Macau. Nice little consolidation here back into the 21. Nike acting the way any strong gap up should, coming back to the 8, holding the 8. This is the type of stock that institutions can pile money into and feel somewhat safe with technology absolutely not working. The volume patterns are near perfect. Uh, Not much more you could ask for than what Nike's done since its earnings gap up. And pick an ETF that's representing really 5 mining stocks: Vale, VALE, FCX. I'm not going to remember them all. Rio, SCCO, and I can't remember the fifth one, but this is a way to eliminate the risk from the individual ones. Michael brought this to my attention. It pulled back nicely, held the 200-day moving average, based right along the 21 there, and then you can see the volume on these stocks acting great. There's no gold miners in here. There's no coal miners in here. It's just pure base metal miners. And it gives you a purer view of what they're doing. Very often, XME, which owns all 3 types of those miners, sometimes disappoints, but I'd rather buy the separate miners when I can. So pick added to the list, and those are the 4 that were added. Pick, JD, LVS, and Nike, and these next 17 are what are left over from last week. Ulta, near all-time highs, riding the 8 higher. GE, nice breakout. I originally put this on because I wanted to monitor GE Healthcare, but GE is benefiting from that spinoff as they still own quite a bit of it. GEHC is acting well, but we need it to form a base. You're seeing a lot of consistency here with stocks pulling back, tightening up over the 2 weeks of Christmas on lighter volume, not going down, holding the 21 and the 50, and then taking off to the upside in the first week in January. Schwab returning to the list, making new highs. It got taken off the list a couple weeks ago. Crocs continues to move out, although it did have a negative reversal and close near the lows today. Caterpillar, multiple attempts to break out above 241, 2. The third one worked today, above average volume into the 250 area. Halliburton held up the entire time. Oil stocks were getting decimated. So it's one of the first ones out into new highs in this cup and handle. AVGO, the strongest, very liquid of the semiconductors. Fantastic move there today. Lennar home builders oddly continue to stay strong. You got the blue bar, the blue ball there indicating relative strength at a new high. MDGL acting well. Don't have earnings. It was a phase 3 approval. Um, Pulling back right into the ADMA and bounced off the ADMA. NVO uh, continuing to trudge higher along the ADMA. 4 bounced again at the 21. United Therapeutics tested the 21 several times, got back above it today. GDX, this is representing all the gold mining stocks that are acting well. I already talked about how it's bounced nicely off the 30 level today. There's ELF, we already talked about that. SARK, short Kathy Wood, is still above the 21. I'm keeping this on here. This is going to be a key to the strength of junk stocks or the weakness of junk stocks. Really, it hasn't gone anywhere this week. In fact, it was down, or meaning ARK was up slightly. But as volatile as those stocks are, you would expect better action. But the stocks are just such garbage, most of them down. We talked about it on the podcast over the weekend. I brought up a chart and showed a comparison chart that showed how terrible the stocks were last year. Moving on to 5, held the ADMA, nice volume patterns the last couple of days. And finally, Boeing. This is the really try to find a stock that's been acting better over the last 2 months than Boeing. We still own this, should own more of it, but a lot of times things that lead while markets are soft and then you get a rally, they take a break, but no break today in Boeing. Its highest volume uh, going back multiple weeks into the pivot plus 20% area. We'll see how it acts now. It is getting extended on an ATR basis from its 21 day. But this is just being bought hand over fist by big fund managers looking to put money to work. That's going to wrap it. As always, love to hear from you. Did I show my magic chart? I don't think I did. Got to show this at least once every show. This is why we protect capital. There'll be some point when we'll be not in a bear market and in a bull market, and I'll stop showing this. But until we get back above the 200-day moving average and start making some progress, you still have to be concerned with the market when you're under the 200-day. This is where all these bear markets occur, but certainly a good start for bulls today. Now we need to see if we can get follow through the next week on it. So remember, folks, it's not how much you make in the markets, it's how much you can keep. We've always got that downside protected liquid capital at a high base. So now we can start compounding it if the market is going to give us the opportunity to. We've got our list of stocks. We dipped 30% into the water, 27% to be precise. If things start working, we'll get our beta up to 1 very quickly to be even with the market, and then the growth stock setting up will take over and we'll put even more money to work. And that's when you can show true outperformance like we did the last half of 2020 after COVID. Seems like forever ago. So that's going to wrap it. As always, love to hear from you. Email is don@revereasset.com. If you're interested in becoming a client, email dan@revereasset.com or call us at 855 Real Wealth. That's 855-732-5932. Long video today. A lot happened. Big day in the market. We'll digest it all this weekend and see what the markets throw at us come Monday. So wrapping up the first week in January, January 6th. This is Don Vandenbord telling it like it is. Just the facts here at Revere. We appreciate your patronage. Love all our clients and followers. And everybody have a great weekend.